Good afternoon, everyone. I'm Erich Patten, the Chief Investment Officer at Cutler, and I'm joined today by Bryan Knutson, Senior Wealth Advisor here at Cutler, and this is our 2022 Market Outlook. I want to start just by welcoming all of the Foundation's asset management clients, as well as the Brooke Anderson clients who have joined Cutler recently. Welcome to the Cutler family. We've grown by quite a bit over the last year or two, and we're now happy to be over $1 billion in client assets. So lots of exciting things happening at Cutler. I'm in our Bellevue office, and Bryan is just across the water in our Seattle office. And I just want to start out, there was lots of interest in today's call. So thank you everyone for joining us. Perhaps it's the market action we've seen at the beginning of the year. You know, we have the first 5% correction of 2022. The market at least 5% off its highs. The NASDAQ today had a 10% correction. So we've really seen some volatility out there in the stock market. But, you know, our clients are long-term investors. You know what to do. You know what we do for you. And, you know, this is the 27th correction of at least 5% since the financial crisis. So this is really not unexpected. But let's talk about what Cutler views is happening out there, what our outlook is, and how we're going to position you accordingly. So let me share my screen here and jump right into our presentation. All right, first and foremost, some disclosures. This presentation is as of January 19th. Obviously, as new information becomes available, we adjust our outlook accordingly. But you know, we do our best with the information at hand to forecast for you, and we want to give you some real content today to take action or to really show you what actions we are taking in your portfolio. So, Bryan, why don't you start off with our themes for the year? What should our clients and investors expect?
Okay, well, excuse me. Good afternoon, everyone. Thanks for joining us. The first topic on the list here is a topic that we certainly have talked a lot about, and we will continue to. That's inflation. Inflation did reach the highest level since 1981 for the month of December. We're going to talk some more about the components of that, some drivers. We do believe that inflation will start to come down. I've been one of our inflation hawks, and even I will say I think it's going to come down. We'll talk about some drivers of what could keep it a little higher than we'd like, but some other things that do seem more, I'll bring back a Powell word, transitory. One reason that I do think it will start to abate is what the Fed's about to do. And we do think they will start raising rates in March. As of now, the expectation, the futures bet is on 4 rate hikes of a 1/4 point each. Some are saying 3. A certain chief executive officer came out last week and said 7. That seemed to be more like what's really out there, but that discussion is out there. What does that lead to? Bond yields starting to normalize. Will the 10-year Treasury reach 2%? It almost did this morning. Came back a bit during the day, but it did touch on 1.9, which is a big move from where it was at about 1.2 not that long ago. Value stocks gain momentum. Erich noted it just now. One way to also look at that is big tech stocks losing momentum. The NASDAQ, which isn't entirely tech, but is mostly thought of as tech, did hit a 10% drop, a true correction from its high. Value stocks of the type that we emphasize, not nearly to that level yet, but of course, many stocks are down. International benefiting again from the currency trends. What I mean by again is this is another way to look at international has done well by not losing as much this year to date. We see some good opportunity there that's gotten even better on a relative basis. And then down below, will 2022 look like the opposite of 2021? Of course, it won't be the opposite, but will some of the trends start to change? Absolutely. What was one of the things that will drive that? Federal Reserve action, for example. So there are different drivers out there that we need to be aware of.
Yeah, Bryan, that question is a little bit tongue-in-cheek at the end. Obviously, with the S&P up 28% last year, we're not looking for a negative 28% in the S&P 500 this year. But a lot of the themes on this page are really the opposite of what we saw last year. and maybe not to the extent that we saw them. Large cap growth could still do well, but we think that large cap value, there's really a catch-up trade. And so far in 2022, that's played out. Let's talk about what those themes, how they apply to portfolios. And we're kind of giving you the punchline up front here, and kind of sharing how we would position for those themes for the coming year. Let's start with bonds. Bonds did great in 2019 and 2020. And then last year, with rising rates, we saw bonds sell off a little bit, and we had a negative total return in the bond market. We would be positioning bond portfolios shorter term. As the Fed continues to rise, we don't want exposure to the long end of the curve, and we'll talk about why later on. And we would also underweight treasuries versus corporate bonds. We think that having credit in your portfolio is the right way to get some yield, get some return from your bond portfolio without taking too much risk. So let's move on to stocks. Large cap domestic stocks again led returns last year. I already mentioned the S&P was up 28%. But our bias continues to be, and those that know Cutler and have been with Cutler a long time know that we love dividend paying stocks. Our bias is that dividend paying large cap value type of investment. And Bryan already mentioned how the NASDAQ was down 10%. That's really a growth index you can think of. Value stocks have held up a little bit better in a rising rate environment. Those value sectors and value types of stocks historically have outperformed. So we think they're set up very nicely for 2022. How about foreign stocks? Foreign stocks actually had a pretty good year last year. And you may not realize it because they kind of get thrown out in the wash with how well the domestic markets are doing, but at least developed foreign did great. Emerging market stocks are really where you saw the struggles last year, and they were slightly down in 2021 due to a lot of things: supply chain issues, country level restrictions. In China really changed their economy last year, and that had a large effect on their domestic stock market. And then finally, alternatives. And what role do alternatives have in a portfolio? Alternatives can mean a lot of different things. We define them as anything that's not correlated to stocks and bonds. So some people might think of Bitcoin as an alternative or real estate as an alternative. For the most part, we recommend for our client portfolios an alternative that tracks hedge fund returns, called the Goldman Sachs Absolute Return Tracker Fund. We still think that's an appropriate proxy for bonds in a portfolio. So we like to recommend that for clients, really in lieu of adding to their bond exposure in an environment where bonds may not have that attractive of a return, even as the year progresses. The 10-year still may not be that viable for a lot of client portfolios. So we want to emphasize other asset classes like alternatives. So Bryan, we call this our Quilt Chart. What jumps out to you on the Quilt Chart here?
So this is a chart that we love. This goes back to, in this case, to 2006. So we have 16 years inclusively worth of data here. And there's a lot of numbers and a lot of asset classes, but I'm going to highlight two for you. Let's look at the black boxes and the darker brown boxes. The black box is big cap US stocks. That's the broad world of stocks from Berkshire Hathaway to Apple to Home Depot, et cetera. It's not growth or value, it's everything. And if you go back historically, back in the 06 to 11 to 12 to 13, where did those tend to finish? Right in the middle, right? No matter if we were in an up market or a down market, those tended to finish in the middle, which makes them a great building block. What have we seen in more recent years as interest rates have come down to literally zero? Those returns have risen up. They have, again, they might not win on a given year, right? They almost never win, but they've gone from the middle to near the top. That has led to some very outsized returns that have led to some very high valuations, especially in very specific pockets. That is something to watch out for. The flip side is the darker brown box. That's the broad world of taxable bonds. Erich noted it up front. Look at 2019 and 2020. In 2019, aggregate bonds got a return of almost 9%. In 2020, it was over 7.5%. Did we have interest rates then? No. Right. So what really drives returns like that is market price going up, largely in anticipation that you're not going to get interest rate increases, right? Because if I don't anticipate a better bond coming, I will go, all right, well, I'll pay a little more for these ones that exist right now to get a little extra yield over what I could get otherwise, right? It gets very dry and mathematical, but it does exist. Now that phenomenon is there. And then what do we get in 2021? You go, well, wait a minute, these prices are getting really high and we get a negative year. However, keep in mind that a negative year, a bad year for bonds last year was -1.5. Okay, all of us on the room here, especially Eric and I in particular, but many of you on the call have been through multiple market periods for stocks where 1.5. I mean, we lost that much in stocks today, right? So the difference here, the range of return, I'd rather have bonds in those good years and those bad years because it's still a mitigator against volatility. But that's something to watch out for, is that large cap has gotten stretched. Bonds already were stretched. They're starting to come down. We need to see some change going forward in interest rates to make those attractive again.
Yeah, and Brian, when you add up those three black boxes at the top, the last 3 years, you get about 100% return from large cap stocks. That's a pretty phenomenal run that we've seen from largely the S&P 500. And we'll get into that later on as to what valuations look like and where we see opportunities in the stock market. But first, we want to walk through really a few themes here for the coming year. The first is the coronavirus, which has been a theme for the last 3 years now. But this next chart will not surprise anybody. We've all seen the spike in cases with the Omicron variant. And the good news is we're starting to see really a cresting of those numbers, especially on the East Coast, where we saw the variant first spike up. But while the U.S. may be actually turning a corner on the variant, that's not necessarily the case in the rest of the world. And why this is still important is this headline on the bottom of the page. China's Omicron outbreak is even worse news for global supply chain. That's a Bloomberg headline that we put here in the presentation. And China still has a zero COVID policy. So when the virus shows up at their ports, the restrictions and the lockdowns can be very severe. And as we'll discuss, we have a supply chain problem right now, and we have to keep an eye out for whether or not this variant interrupts that supply chain even more or impacts Chinese growth as well. So, we're all part of this global economy, this global supply chain. And while things in the U.S. look to be turning a corner, and we're optimistic that they will, we have to keep an eye out for what's happening in the rest of the world. Brian, what happened as the Omicron variant that news came out around Thanksgiving? How did that impact economic growth and activity in the fourth quarter?
So this is a great chart that we've seen before, and I really like this because it shows two different aspects of how consumers can approach activity. The first line is going to be debit and credit transactions of any kind. That is whether you're making an online purchase or if you're at the Ritz-Carlton checking into your hotel, right? It can be either of those aspects. What we saw there was, if you go to the left-hand side of this, we're comparing to back before any sort of restrictions, lockdowns, whatever we want to call them, started to begin. That was in February of 2020. A lot of this activity dropped almost to zero, right? The US seated dinners and airplane travel went as close to no activity as possible. And then we started to see some rise back up. We saw some really nice trend lines going all the way through August of 2021, when the Delta variant started to arise and become the major source of cases. We saw a sharp drop in activity. That's where we saw some push off of things that people wanted to do that they couldn't do. What did we see around November? The news came out about Omicron and from South Africa and all that in late November. What do we see? Another drop. Thankfully, so far, what you can't see on this screen, but we've seen with some reports since then, is that we are starting to see some rally back up, largely for the reason that Eric noted before. We're starting to get used to how to deal with this. The severity hasn't been as strong. I had it, for example, I didn't even know it. I just had a mild cough. Hey, great for me. It's not the same for everybody. But the ability and the willingness of people to rally back up out of this and maintain activity is going to be paramount in our ability to maintain strength. We're going to talk further about the source of economic strength here in America, but here's the punchline. It's us, right? So our willingness and ability to do the things listed on here, plus all the other things that we want to do, will be very key. We did see a similar drop in November, December as we did in August. Thankfully, so far, that rally up has already begun and is looking pretty good so far.
Yeah, and you can see a little bit of a tail off here, definitely a tail off, but retail sales were disappointing in December, but keep in mind they were still 17% higher than 2020. So, we did have robust growth throughout the economy. One of the things to be aware of is part of that increase in sales comes from increased prices, right? Because you're seeing a revenue number. Procter & Gamble announced today, great earnings numbers, but a lot of that was driven because their prices are higher. So let's talk about inflation, which is the other big story of 2022. Why we think it might subside and where we are currently. Bryan, walk us through this first graph here.
Okay, so to no surprise to anyone who sees these headlines, inflation has hit another high. The chart here on the left notes a number for CPI, Consumer Price Index. This is the headline number, which does include food and energy, which I'd say makes sense because I know I spend a lot on both of those. And that number started to drop in 2020 when there was some restrictions, many restrictions on activity, started to climb. To give you an idea of what the breadth of this climb has been, in July, that number was 5.4. And then the next month was 5.3. We gone up and hit a bit of a plateau, and then we got another jump, and then we got another jump. The number got to over 7, right at 7, I'd say 7.04. So it's 7. What were the key drivers of that so far? Food prices, gas prices, and vehicle prices. Those three in particular. There's some other ones as well. Those are your big three drivers. And then you get news like, this was interesting, Netflix goes from $14 to $15.50. Like, well, it's only $1.50 a month. That's an 11% increase. Like, oh, okay. So, any of those types of increases are all going to get collected up together, go into their various categories, and we're going to see some increase. Why do we think that this number could start to abate? Some of those numbers will not stay on the same trajectory, right? Like Erich noted before, for oil to keep going at the level that it does would be unrealistic, right? It's not, I hope, it's not going to be $200 a barrel at this time next year, which is what it would have to be to maintain the trajectory it has been on. Food prices, to the level it has been, would be very unexpected to stay like it is. However, what could jump into the fray and take the place of some of these areas that should not go up as much? Let's look at the chart on the right. This is housing. Two different aspects of housing. The dark blue line is the increase or decrease in rent. The greenish line is the increase or decrease in housing purchase price. What do we know? Rent increases don't tend to go up by as much as housing increases. If you can see that, then the chart on the left, the scale, only goes to 5% for the rent side and goes to 20% for the housing side. Okay, so this scale, you have to keep in mind that they're not the same level of number, but the trend lines move very similarly. And what have we not seen? Rent increases to the degree, to scale of the housing price increases. There's some reasons why it might not, but keep in mind that rent was locked down for quite a long time, right? There was no increase in rent allowed. There were eviction moratoriums, et cetera. When that alleviates itself, which in many cases it already has, you start to see that trend line increase. That could take the place of some of these other numbers because it is such a substantial part of CPI.
Yeah, and we've seen mortgage rates begin to climb, and that might also slow down the housing price appreciation. We're back to levels last seen right before the financial crisis. The Fed's actions this year will definitely have an impact on mortgage rates and interest rates in general as well. But let's talk about supply. And supply issues, Goldman Sachs estimates could be 70% of the inflation that we're seeing. This chart on the bottom left really demonstrates what's happening in that supply, those supply constraints that we're having. Bryan, walk us through that chart.
Sure. Okay. So this is a measure that you've probably seen some stories about: container ships trying to get in, unload their goods coming from primarily from Asia, but also some other areas, and then get out of the ports. Container ships waiting for berths in LA/LB. That's Los Angeles Port, Long Beach Port. This only goes back to October of 2020, so it doesn't have a lengthy history, but we do see quite a lot of variety in the volume of ships waiting. You see it at low of 9, a high of actually over 100. And so in the blue, those are the ones that are visible inside of the port area. Some stories have come out that are kind of wishful thinking to say, well, this looks like it's getting a lot better because look at that trend line go down. Unfortunately, kind of like if my girls say they clean the room and they really just stuff stuff into the closet, it's not because the ships are less, it's because they're not as visible. They are further away from shore for some environmental reasons and just for some kind of lack of clogging reasons. The volume of ships is still, unfortunately, quite high. What has gotten better is the supply chain to get those ships unloaded and off, right? So some agreements have been made with places like the longshore unions and some of the the trucking companies and things like that. They've worked out some arrangements that hopefully will be beneficial for everyone and start to alleviate some of that pressure. But I hate to say to provide too much bad news, but I just this is important to have that distinction there. Some stories are saying, well, look, you can't see as many ships. Well, unfortunately, it doesn't mean they're not there. Okay, so what do we do in the meanwhile? If you go to the right-hand side, this was a survey that came out kind of into the beginning of the holiday season that we just had about what do people expect to buy as gifts for this year. You can see many of those areas are about the same between 2019, 20, and 21, but two areas in particular really jumped up. The very left-hand side is gift cards. The very right-hand side is experiential gifts. Why would you go to those? Because if there is the expectation or the practical reality that you can't fulfill an order for something like the Nintendo Switch that I searched for a month, then what you're going to do instead is look for something that can be purchased now and used when available. Gift cards can certainly fill that bill, and experiences, right? I don't need to have a thing there to say we're going to go to the Grand Canyon this summer or whatever it might be. That can help to alleviate the near-term pressures, right? So what does this show me? People are still willing to spend. Eric had a great note before about the volume increase in revenue for the holiday season over last year. It was a very strong number, and it lasted for quite a long time, from mid-November through the end of the year. People were willing to be flexible, go to some other ideas, and that can really help to alleviate some of this stress and pressure as well as we work through these issues.
Yeah, so that covers the supply side of inflation, but there's also a demand side. Milton Friedman famously said inflation is a monetary phenomenon. And what that means is a lot of money in the system chasing fewer goods or chasing not enough goods will drive prices higher. That's just the nature of how money works. And on the charts on this page, you can really see how much money is out there in the system. We saw upwards of 25% of GDP was injected into the economy through fiscal and monetary stimulus during the pandemic. And that's really left the consumer in great shape. And we're going to talk about the consumer a little bit more as we move through this presentation. But let's look at the consumer balance sheet. Bryan, you've been very impressed with how well consumers are positioned and really the opportunity for consumers to maintain consumption going forward.
Absolutely. So let's look at the chart on the left. This shows the state of the American household in general. The very first thing that I would look at, like if a client came in and we had a chat, we talked about their balance sheet. I would look at this balance sheet and say, you have a 9-to-1 assets to liabilities ratio. That's fantastic, right? So the state of the American household is quite strong. The state of other finances, like at the government level, that's its own thing. I'm worried about what are Mr. and Mrs. Smith or myself or someone down the street. How do we look? We look great, right? What are the sources of all of these assets? 25% of that is in houses, right? And that's that purple area at the top there. That's about $40 trillion of house ownership level. It's great. It's fantastic, right? I like that number because it's not too high. If that was 50% or if that was even 40%, I'd say, oh boy, some erosion in that value as we get, let's say, an increase in interest rates, which makes the purchasing power a little weaker. That would be a concern. But right here, 25%, I love it. Let's drag down to the bottom. Pension funds and other financial assets, which would be brokerage accounts, 401k type accounts, 60% combined. It's fantastic. That's about $100 trillion. Let's wrap our heads around that number. $100 trillion in financial assets that are not bank deposits and are not our homes, right? That's a great number. Let's go over to the right. 65%, 2/3 of our liabilities at a consumer level, at a household level, are mortgages. Again, fantastic for a couple of reasons. First, no matter even if we just signed a brand new 30-year mortgage yesterday, I still know it has a finite lifetime, right? It's going to be 30 years. That's a long time, but it's not 50 years or 100 years. And it's not credit card debt at 18% or 22%. It's going to be at a known number, even if it's a variable rate. And even if you get 4 rate rises this year, it's still going to be a containable number. And it's still going to be a number that's going to work itself down. And it's mortgage in a home. The other liabilities, excuse me, on their credit card debt, student debt, et cetera, in isolation, those numbers can look big, but relative to the state of the households in general, they're fine. Let's drag over to the right. Household debt is lower now as a percentage of total assets, of income, excuse me, of disposable income than it was in 1980. Okay, well, someone says, well, 1980 mortgage rates were really high. Yes, but house price levels weren't nearly as high as they were now, right? The magnification of that has been much higher since then. One big reason why, interest rates have done this in that entire time, right? A 13, 14% mortgage is now in the 2s realistically, or the 3s, maybe even the 4s. Think about that. A high mortgage rate right now is probably 4.5, right? Wow, right? So look at the number right now compared to the fourth quarter of 07, right? Is there a bubble? Sure, there are some bubbles in things like certain specific stock prices. Is there a housing bubble? One reason I would say no is that right there, right? The ratio has come down 50%. Well, it's about 40% lower than it was then. Fantastic. And then the last chart down the bottom right shows that nice steady increase in the aggregate household net worth. And one reason, again, that does not give me concerns. I mean, I'm glad to see it. And one reason it doesn't give me any nagging concerns is I can look to the left and see where the sources are, right? It's not hyper concentrated in one area. It's really well spread out over multiple areas. Fantastic.
All right, so we're going to jump from inflation to just talking in general about the economy now and what we see for GDP growth. We've already mentioned that we think inflation could come down in the second half of the year, but let's talk about employment. Do we have full employment or just low unemployment? That's a little bit of a play on words there, but the top chart shows the unemployment rate, and clearly we had a spike when there was a shutdown. Everything locked down. We had unprecedented economic devastation really overnight. But we've been steadily and aggressively going lower in unemployment ever since. We're at 3.9% now. That's great. But Bryan, is that the whole story or just part of the story?
It's a good part of the story, but it's definitely not the whole story. So Erich said it very well. The number on a percentage level of unemployment, which is very important about how we define that, has come back down to a level that is lower than I thought, say 20 years ago that we would ever see, right? Academically speaking, full employment had been thought of at about a 5% unemployment rate, and it's come down lower than that. However, here's the wrinkle. Let's go down to the bottom. The United States has an expected workforce, a full-time workforce of about 160 to 170 million people. So I'll split the difference and say about 165 million people in the United States would be expected to be full-time workers. Okay, that would be a participation rate in the workforce of what is of the people that are of an age that you would expect them to work. It has gone from about 67% back in 2001 down to about 64% in 2019. We, baby boomers and such, the number coming down as a percentage, not overly surprising, excuse me, if you have more children and or more people, kind of think of it as a barbell. There's more older and more younger. Okay, I'm not surprised that the number has come down, excuse me. But the problem right now is it hasn't come back up even to what it was in 2019 to early 2020. There's a disparity there of about 1.5%. It goes from about 63.5% before to about 62. Okay, well, that's a lot of percentages. What does that mean in people? That is about 2.5 million people, maybe as high as 3 million people that have made the choice or have had the choice made for them in certain cases that they are not going to be fully employed right now, right? So that's that difference of the unemployment rate measures the number of people who have expressed a desire to work and aren't. They just haven't found a job or they're unemployable, whatever it might be. Down at the bottom says, we have the Great Resignation with people that have quit and expect to find something better. We've had people that with, say, like daycare issues, where there are, in particular, some moms and things that are people like that aren't working right now. Whatever the specific situation is, 2.5 million people, I think, is a fair estimate of the number of people that we would expect to be working right now that are not. Whether or not that gap can be bridged or even will be bridged is going to have a big impact on consumers, because that's more people that will be earning money, that will be spending money, that will be helping to drive the economic engine.
Yeah, and if you're looking for a reason why the Fed has taken so long to raise rates, that bottom chart is probably it. The Fed obviously has been ignoring their inflation mandate for a full employment mandate. And the big question is, are these people going to come back into the workforce or not? But I think the Fed has decided that it's time to tackle that inflation mandate and not worry so much about the full employment. So let's talk about GDP growth. And this is really a good news story. Over the summer, we saw Delta really take hold of our economy, and we saw GDP expectations drop all summer long. Ultimately, we ended up with a 2.3% quarterly growth. Well, what happened? A lot of that growth got pushed into the fourth quarter, and now we have estimates, and you can see on the top line of the left chart here, this green estimate, the fourth quarter growth rate looks like it might come in near 7%. That is a phenomenal growth rate for an economy our size, and I think is great news all around. The fourth quarter looks still better than the blue chip economic consensus, meaning the economists out there that predicted what we would have, we're going to come in at the top end of that range. That's the good news story. The bad news story is that we're seeing a little bit of the same story play out this quarter. And we started the quarter really with a 4% expectation for growth. With Omicron kind of taking hold and the impacts that we've seen on economic activity, growth estimates now are more like 2.5%. The question is that 1.5% difference going to get added to the second quarter? Are we going to see people who canceled that trip over winter break because they were worried of the outbreak, then maybe take a spring break trip with their family? Is that spending going to happen later in the year? Given the shape of the consumer, we think it will. We think that peak growth this year will be in the second quarter. Let's talk about the consumer just for a minute, Brian. How important is spending, consumer spending, on hitting these growth numbers?
It is absolutely, it cannot be beaten by anything else. It is essential. It is mandatory for us to have growth to come from us. Let's look at the right chart there. 69%, over 2/3 of our GDP construction is us, right? Look at the number right above it. Government spending is high at 17.5%. On past charts, past quarters, that would be 12, that would be 13, that might be 14. That number has definitely come up, and that's been the spending programs and the the secure and the cares and that number is big. It is dwarfed by us, right? We are 4 times bigger than that. Out of a $23-ish trillion economy, 70% of that is about $16 trillion, right? Is from us. That is us going on those trips. That is our professional work. That is our purchases. That is our house. It's everything. It's all of that all together. Oh, sorry, it's not housing. That's up above. But it's house remodel would count there. Anything to do with us using money, using our spending power, using our equity in our home. All of that activity is right there. We need that to remain as high as possible to maintain the trajectories that we've had. And like Eric said, are we going to get 6s and 7s going forward? Well, no, but we're not going to get a -30 either, right? That we had during that freeze period. To get on a consistent glide path we need to maintain our willingness, both our willingness and our capability to do the things that we choose and want to do. The cash is there, absolutely. The spending is there, the employment is there. And hopefully we'll build up, the number of workers that we looked at before. But all of that is in place. It's just the ability and the capacity to do the things that we already want to do and get them done. That's what we need.
Yeah. So to sum up this part of the presentation, we think growth has a solid foundation, largely because consumers have a solid foundation. We saw the balance sheet of consumers before, and we think that they can continue, or we can continue to spend money and drive this economy forward. So for the last 10 minutes, we're going to just walk through equities, talk about valuations and opportunities, and then we'll end with a couple of slides summing up our view on bonds. But this is obviously what most of our clients are interested in. What happens to the equity markets? What does all this mean for my portfolio? And we'll start with some valuations. The question is, are stocks still expensive? Yes, but that's not the whole story. Perhaps my favorite statistic that we're going to recite to you today is the following. Last year, the S&P was up 28%, but earnings growth in the S&P 500 were up 34%. So stocks got cheaper last year, which is remarkable when you consider how well the S&P 500 did. But the valuation of the S&P got cheaper in the last 12 months. There's always nuance as to everything we're talking about today, and that's not the whole story, because we also have an S&P 500 that's increasingly dominated by a few companies, and those companies might be driving earnings and valuations higher. Bryan, talk to us about what's happening in kind of the concentration of the S&P 500.
Sure, yeah, so let's look at the chart on the left. This is through December 9th. So there was a few more weeks of activity after this, but most of the year's gains had already happened by then. What this chart is telling me is that 5 companies drove 35% of the return for the aggregate index. Are they the only 5 companies that were up last year? Of course not, right? But they are so big that their gains just dwarf the impact of gains of smaller companies. Apple, which you can see on the far right-hand side there, became the first $3 trillion market cap valuation company in the world. And then it's had some downturn since then, like many of the tech names have. But just think about that, $3 trillion. That's bigger than the economy of almost any country in the world. We're one of the exceptions, but that is staggering, right? So what this tells me more than anything is these big companies by valuation also had big gains for the year, through that date in particular. Great, okay. That doesn't mean that those other remaining 493, which is I think actually a few more than that even, companies didn't do anything. It's just that they are relatively speaking so much smaller. It's kind of weird to think that you could like Domino's, I was looking at, is a $45 billion company, and Apple could buy that with money it found in its in its pocket, right? It's so crazy to think the disparity of size has really driven this disparity of returns, right? The contributors of return. This tells me multiple things. First, that the erosion we're seeing, like why is the NASDAQ down 10, but the S&P is only so far down 5 from its highs? Because the S&P has a much broader base, right? It's not quite as concentrated in those certain companies. This also tells me that our select construction, there's been some questions about kind of construction and how do you value versus growth and such. Having distinct pieces there helps. If someone just has the S&P 500 index, that's fine, but you are going to rise and fall by essentially what 20 companies do, right? Not 505. That's just not realistic given the size disparity. Think like a $40 billion company being up 100% versus a $3 trillion company being up 5%. The $3 trillion company will have a greater net impact on your return if you have only one piece that's market cap weighted. So this doesn't mean that any of these companies in particular did badly. Even last year, I'd say out of the 500, I believe the number is about 350 stocks had a positive return for the calendar year 2021. But if you're number 350 on that list that had a +5 or whatever, you're barely going to notice, right? Unless you can get to some pieces that are much more specific in your holdings.
Yeah, and one thing that jumps out to me on this chart is that it's really exciting time to be a stock picker because there's a lot of opportunities outside of those big five. But let's talk about earnings growth. You know, I already mentioned that earnings went up 34% last year. Can that continue? Maybe not to that degree, but there is an underlying kind of bid to earnings, and it's shown on the right side of this page, which are stock buybacks. So stock buybacks reduce the number of shares available, and so the same dollar of earnings that you might have translates to higher earnings per share because you reduce the number of shares available to purchase. And since the financial crisis, about 40% of earnings growth has come from stock buybacks. We think that's going to continue. The right side of this chart shows, you know, just how large stock buybacks have been. We saw a dip in 2020 naturally, as nobody knew what, you know, how the pandemic was going to unfold. Companies slowed down their stock purchases, but we see this continuing. You know, with interest rates still very low and likely to, they're going up, but likely to not go up too fast. Companies can borrow and buy back shares to their heart's content. So there's still that underlying earnings growth momentum from share buybacks alone. All right, so we mentioned this theme earlier. We want to just highlight one of the reasons why we think that international stocks are attractive. We're not going to belabor the point here, but this chart is a ratio. It's the ratio of valuations of the US versus valuations of the rest of the world. And you can see we're at 17-year highs here and really have gone parabolic recently with that valuation spread. If this were to normalize at all, investors would really benefit from some diversification, some foreign exposure in their portfolios. And that's why we advocate a portion of an asset allocation approach to having international exposure. So let's end here with some bonds. And bonds always start with a discussion of the Fed. We've mentioned the Fed quite a bit today. But Bryan, this chart definitely shows a change of regime. What has happened in terms of the Fed's outlook for interest rates?
Well, I'd say, well, two things happened. The first one is that Chairman Powell finally came out and said, let's drop the word transitory. The immediate reaction to that was, all right, well, if it's not transitory, what are we going to do to tamp it down? We're going to increase the likelihood of more rate increases. And so this chart looks at the futures expectation of having 4 rate rises this year. There's, you know, similar charts about what's the chances of 1 or 2 or 3. This one is about 4. The chances of 4 rate rises, essentially 1 per quarter would be the expectation, has come up to almost 9 out of 10. All right, well, look at when that changed in October, right? It went from 2 out of 10 to 5 out of 10 to 7 to almost 9. What does that tell me? There's a very likely chance that we're going to get at least 3, if not 4. Okay, what does this play into? And we're going to look at it on the next chart as well, but just a little sneak preview. This is one of the biggest reasons why we keep a short duration. There was a 5, 6, 7 year period there where some people just sat on long bonds and went, well, rates are never going to go up again, which of course is wrong, and they're not going to never go up. But they thought that it was so far out in the future that you could just keep banking on increases in price of treasuries to the point where you were seeing treasuries trading for like $1.40 per dollar. That's insane, right? What would make that change? This would make that change. So if this comes to play with either 3 or 4, we're going to still feel very good about being short on the bond side for duration, because you do not want to get caught with long bonds that aren't attractive anymore. You're going to have to sell them at a discount.
Yeah, I know we're in the bond section of the presentation here, but I do want to address a question relative to stocks. The question is, can stocks continue to go up while interest rates are going up? That question really addresses kind of competing asset classes and how, you know, bonds become more attractive. Are people going to sell their stocks and buy bonds? I've seen estimates that say that dynamic really takes hold when the 10-year hits 3.5%. We're nowhere close to that level of relative value right now. So, you know, we still favor the stock market relative to bonds. We think that bonds, even at, you know, the 10-year now up to 1.9 almost, is still not a great long-term investment from a total return standpoint. It really does provide protection and is a necessary component to a lot of asset allocation portfolios. But we don't see investors trading off their stocks to rush into a 10-year at 1.8%. We don't think that dynamic is likely to happen in the near term. So for your bonds, where should you invest? Here's how have we invested, Bryan, and how does this chart really drive our decisions to position client portfolios?
Okay, so the big picture on this chart is that there's not a lot of sweet spots in bonds right now. That's just kind of the reality of it, is that if you're looking for opportunities, the opportunities would be in things that are risky enough that I can make a pretty fair case to say value stocks are less volatile or less aggressive than things like senior loans, for example, on the right side. But let's look at the gold circles. There's a lot of lines and a lot of classes here of bonds. The gold circles are really the drivers for me. How much yield could I expect per unit of duration, which for bonds is a measure of risk? And what it tells me on here is that the worst is treasuries. That is not surprising. That's like telling me the sky is blue or in Seattle gray. So that's not surprising one bit, right? Treasuries look bad right now. Why? First, because they got overpriced, like I noted on the last slide. Second, because there's way too many of them. So they're just this bloated marketplace. What are we doing instead? We have some positions here that are emphasizing short duration, corporates, and other things. We have some treasuries. It's hard to not have any. And of course, there's some security there. But basically what this shows me is that the best thing that could happen for bonds is we maintain a short duration, because then I can turn over those bonds faster when new bonds come out. What do I want as a bond investor? I want interest rates to go from, I want a new treasury, let's call it, to go from 2 to 2.5 to 3. I would much rather wait for that, right? I would have the opportunity to offload the bonds I don't want anymore and get some of these newer ones to take advantage of that upside, rather than being stuck in, like, say, a 30-year bond right now, which has a yield of about 2.2. No, I'm not doing that, right? I don't want to sit on something for that long or be forced into a sale at a weak price, when instead what I can do is just let these positions roll up. But overall, like, almost every one of these dots is at or below zero. I don't love that, but what do I still love about bonds, or like about bonds at least? Let's go back to the Quilt chart before. A bad year for bonds was -1.5, right? What's happened in the last 3 weeks of this new year? The NASDAQ has corrected to a -10, right? That's a very specific set of stocks, but a lot of those overpriced stocks have come down. Bonds have helped to provide some buffer. Bonds still provide recurring income. Bonds, they reduce the magnitude of ups or downs for a blended portfolio. They're doing what they're supposed to do. And I'd again go back and say, why did they get an 8.5% return, or almost a 9 really, and then a 7.5? Because people thought at that time rates weren't going to go up. Now we're bearing the consequences that they will go up, right? They have to go up. They will go up. Bonds still have a place, right? It's just that we need to be selective in how we construct that portfolio, and I think we have done that.
All right, so in closing, I just want to thank all of you for joining us today. For those of you that are new to Cutler, again, welcome. We're happy to have you. Both Bryan and myself are always available to answer any questions answer any questions from the presentation today, or anything we did not address in the presentation as well. But we encourage you to reach out to your advisor at Cutler to talk about your portfolio, to talk about how these thoughts might be implemented in your portfolio, or what Cutler is doing for you. So thank you so much for your time. This presentation will be posted on our website. So if you'd like to review the presentation or recommend it to a friend, please send them to cutler.com, and it'll be up shortly. Thank you very much, and we wish you all a prosperous 2022.
Thank you, everybody.